I was monitoring the final trading session of 2025 when the most violent destruction of institutional resistance in precious metals history unfolded before my eyes with mathematical precision that revealed the complete collapse of traditional market control mechanisms that had governed silver pricing for the past 40 years. Friday, December 27, 2025, 3:45 p.m. Eastern Time, 15 minutes before the closing bell, when I witnessed silver explode through the legendary $78 resistance level that banking institutions had defended with billions of dollars in coordinated selling, only to watch helplessly as momentum algorithms and gamma hedging requirements drove prices to an apocalyptic closing print of 82.15 that trapped commercial short sellers in positions that could bankrupt major financial institutions if the weekend margin calls proceeded as mathematical models predicted. The destruction had been building throughout the week as industrial procurement officers recognized that traditional just-in-time inventory management had become a catastrophic liability when applied to strategic materials whose availability could no longer be guaranteed through normal commodity market mechanisms, forcing a complete restructuring of corporate purchasing strategies that prioritized supply security over cost optimization, in recognition that production delays caused by material shortages could generate losses far exceeding any savings achieved through efficient inventory management. The technical breakout had exhibited all the characteristics of a gamma squeeze event where options market makers found themselves trapped in mathematically impossible hedging requirements that forced systematic buying regardless of fundamental analysis or traditional resistance levels that had historically provided price containment during periods of speculative enthusiasm. The acceleration had been gradual at first, with silver grinding higher from Thursday's close of $76.80 through systematic buying that absorbed every sell order without creating the volatility spikes that typically characterized speculative attacks on major resistance levels. But at 2:17 p.m. Eastern Time, the mathematics of the options market had triggered an algorithmic cascade as market makers' delta hedging requirements exceeded their available inventory of physical silver and futures contracts, forcing them to compete aggressively with industrial buyers and institutional investors for rapidly diminishing supplies, while their risk management systems demanded immediate position adjustments to prevent unlimited loss exposure from their short call option positions. The gamma acceleration had been unprecedented in its violence and mathematical precision, driving silver from $77.20 to $82.15 in less than 90 minutes through purely systematic buying that ignored traditional technical analysis levels and operated according to mathematical hedging requirements that could not be modified or delayed without exposing market makers to potentially unlimited losses if silver continued rising beyond their worst-case scenario modeling parameters. The options market mechanics had created a perfect storm of forced buying as call options at the $80 strike price, which had been considered virtually worthless just days earlier, suddenly moved deep into the money and required immediate hedging by market makers who had sold these contracts assuming they would expire worthless. Each dollar that silver rose above $80 required approximately 500,000 ounces of additional hedging purchases, creating a feedback loop where hedging activity drove prices higher, which required more hedging, which drove prices even higher. The systematic nature of the gamma squeeze had overwhelmed traditional market-making capabilities, as multiple major financial institutions found themselves competing to purchase the same limited inventory of silver futures contracts, while their risk management systems demanded immediate position adjustments that could not be delayed or spread over time without violating regulatory capital requirements and internal risk limits that had been established to prevent exactly this type of unlimited loss exposure. Citadel Securities had reportedly suspended their silver market-making activities during the final hour of trading as their quantitative models indicated that continued gamma hedging requirements could exceed their allocated risk capital by factors that made traditional market-making economically impossible, while potentially exposing the firm to losses that exceeded their quarterly earnings from all business lines combined. Virtu Financial had implemented similar protective measures, withdrawing their liquidity provision algorithms from silver markets as their high-frequency trading systems detected price momentum that exceeded their mathematical parameters for profitable market making, while creating conditions where their normal arbitrage strategies could generate systematic losses rather than the consistent profits that characterize their normal trading operations. Two Sigma Securities had ceased all silver options market making after their quantitative analysis revealed that gamma hedging obligations could create position concentrations that exceeded their firm-wide risk limits, while potentially forcing them to compete against their own clients for available inventory in spot and futures markets, where liquidity had effectively disappeared during periods of maximum stress. JPMorgan Chase's commodities trading desk had reportedly lost $3.7 billion during Friday's session alone as their massive short position, accumulated over 18 months through systematic selling designed to cap silver prices below $70, was completely overwhelmed by industrial buying pressure that operated according to supply security imperatives rather than normal profit optimization considerations that characterize traditional commodity trading strategies. Goldman Sachs had suffered similar catastrophic losses, with their silver derivatives book generating mark-to-market losses exceeding $2.4 billion as their sophisticated mathematical models proved completely inadequate for predicting market behavior when industrial procurement requirements overwhelmed traditional arbitrage and volatility-based trading strategies that had historically provided predictable profit opportunities during periods of precious metals volatility. Bank of America's risk management team had issued emergency position closure orders during Friday's session, authorizing their trading desk to cover short positions at any available price rather than risk weekend margin calls that could exceed their allocated capital reserves if silver opened Monday morning at prices reflecting the industrial procurement panic that was systematically removing available supplies from traditional commodity trading channels. The weekend margin call mathematics had created unprecedented tension as major banking institutions faced potential obligations that could exceed their quarterly earnings if silver continued rising toward the 90-95 levels that industrial procurement officers were reportedly willing to pay for guaranteed delivery during the first quarter of 2026, when production schedules for electric vehicles, solar panels, and advanced electronics would require unprecedented silver quantities. The Shanghai arbitrage analysis had revealed a staggering $7.40 price differential between New York closing prices and Shanghai Gold Exchange quotations that reflected genuine physical market conditions, where Chinese industrial buyers were competing desperately for diminishing supplies through direct procurement agreements that bypassed traditional commodity exchange mechanisms entirely, while offering premium pricing that Western dealers could not match without abandoning their traditional business models. Shanghai physical silver was trading at the equivalent of $89.55 per ounce, while COMEX futures had closed at $82.15, creating an arbitrage opportunity that should have attracted massive professional trading interest, but was proving impossible to exploit due to logistics constraints and inventory availability issues that prevented normal market forces from eliminating price differentials through competitive arbitrage activities that would typically restore equilibrium within hours, rather than days or weeks. The physical market disconnect had reached crisis proportions as major bullion dealers throughout North America and Europe reported that their normal supplier networks were either completely sold out or demanding immediate payment at prices that exceeded retail selling prices by substantial margins, creating impossible economic conditions where dealers faced guaranteed losses on every transaction while simultaneously disappointing customers who had placed orders based on advertised pricing that was no longer economically sustainable. APMEX had suspended new customer orders for all silver products while conducting a comprehensive review of their supply chain relationships that had been completely disrupted by the Asian buying surge that was redirecting available inventory toward overseas customers, offering immediate payment at premium prices rather than honoring existing supply agreements with American distributors who operated under traditional credit terms and pricing structures. JM Bullion had implemented emergency rationing protocols limiting customers to maximum purchases of 50 ounces, while extending delivery timeframes to 24 weeks as they attempted to source replacement inventory through alternative channels that were proving increasingly expensive and unreliable due to competition from industrial buyers offering guaranteed payment and volume commitments that provided superior economics compared to traditional retail distribution. SD Bullion had temporarily closed their retail website while negotiating emergency supply agreements with mining companies and refineries who were prioritizing direct industrial sales over traditional dealer relationships that had historically provided adequate inventory flows to support normal retail operations during periods of increased public demand for physical precious metals investment products. The European precious metals market had exhibited similar stress patterns as London-based dealers reported that their traditional supplier networks were redirecting output toward Asian customers offering superior pricing and guaranteed offtake volumes rather than maintaining existing relationships with European distributors who were constrained by traditional pricing structures that had become economically unviable in the current market environment. Heraeus Precious Metals had announced a strategic review of their allocation priorities that would likely result in substantially reduced supply availability for Western retail markets as they redirected processing capacity toward Asian industrial buyers whose procurement requirements had acquired national economic security implications that transcended normal commercial considerations and required government support for strategic material acquisition programs. The industrial procurement acceleration had reached panic levels as technology companies recognized that silver availability was becoming more critical than silver pricing for maintaining production schedules that generated hundreds of billions in revenue, while requiring guaranteed access to essential materials, regardless of short-term market volatility or supply chain disruptions that could threaten manufacturing operations. Advanced Micro Devices had implemented emergency silver acquisition protocols with $2.1 billion allocated for strategic materials procurement, reflecting their assessment that secure semiconductor manufacturing required guaranteed silver supplies for optimal electrical performance characteristics that could not be achieved through alternative materials without compromising product specifications. NVIDIA Corporation had established a comprehensive strategic materials division with $3.8 billion designated for critical technology material acquisition, focusing on securing silver supplies for their artificial intelligence hardware production and graphics processor manufacturing that required substantial precious metals quantities for optimal electrical conductivity in next-generation computing applications. Intel Corporation had announced a $4.6 billion strategic metals procurement program designed to secure silver supplies for their semiconductor fabrication operations and advanced packaging technologies that required guaranteed access to high-purity silver for optimal electrical performance in microprocessor designs that push technological boundaries. Taiwan Semiconductor Manufacturing Company had reportedly signed exclusive supply agreements totaling $7.2 billion with primary silver mining operations, effectively removing approximately 90 million ounces annually from global commodity markets through direct producer relationships that guaranteed delivery for their expanding semiconductor manufacturing operations, serving virtually every major technology company globally. Samsung Electronics had reportedly increased their strategic silver procurement budget to $6.8 billion for 2026, representing their largest ever commitment to securing critical technology materials for semiconductor manufacturing, display production, and battery development that required substantial silver quantities for optimal performance characteristics. Tesla's Strategic Materials Division had implemented emergency procurement protocols with $5.2 billion allocated specifically for silver acquisition during the first quarter of 2026, reflecting their assessment that secure silver supplies had become essential for their expanding electric vehicle production and energy storage manufacturing operations. Samsung Electronics had reportedly increased their strategic silver procurement budget to $6.8 billion for 2026, representing their largest ever commitment to securing critical technology materials for semiconductor manufacturing, display production, and battery development that required substantial silver quantities for optimal performance characteristics that could not be achieved through alternative materials without significant performance compromises. Tesla's Strategic Materials Division had implemented emergency procurement protocols with $5.2 billion allocated specifically for silver acquisition during the first quarter of 2026, reflecting their assessment that secure silver supplies had become essential for their expanding electric vehicle production and energy storage manufacturing operations that required high-performance electrical components manufactured with precious metals for optimal conductivity and reliability. Apple's component procurement strategy had designated $4.1 billion for strategic metals acquisition during 2026, focusing on securing silver supplies for iPhone manufacturing, data center operations, and renewable energy infrastructure that required sophisticated electronic components incorporating precious metals for optimal electrical performance and thermal management capabilities that were essential for next-generation technology applications. Microsoft Corporation had announced a $3.3 billion strategic materials procurement program focused on securing silver supplies for their expanding cloud computing infrastructure, artificial intelligence hardware development, and data center construction projects that required massive quantities of high-conductivity materials for optimal electrical performance in applications where alternative materials could not provide equivalent functionality. The collective impact of these industrial procurement strategies had created a supply vacuum that traditional financial market participants were completely unprepared to handle, as their mathematical models had been calibrated based on historical patterns, where industrial demand grew gradually and predictably, rather than experiencing the quantum leap acceleration that characterized the current technological transformation, driving unprecedented silver consumption requirements. The weekend positioning analysis had revealed that major commercial short sellers were facing margin call obligations that could exceed $15 billion in aggregate if silver opened Monday morning at prices reflecting continued industrial buying pressure combined with the systematic covering activities that mathematical models predicted, would be necessary to prevent unlimited loss exposure from their underwater derivative positions. The Federal Reserve's emergency lending facility had reportedly been activated to provide liquidity support to major banking institutions whose commodity trading operations faced potential insolvency from silver derivative losses that exceeded their allocated capital reserves while simultaneously threatening the stability of their core banking operations through interconnected risk exposures that could amplify losses across multiple business lines. The Treasury Department's Financial Stability Oversight Office had initiated emergency consultations with major banking regulators to assess systemic risks posed by precious metals derivative failures that could propagate through interconnected counterparty relationships while potentially disrupting normal functioning of credit markets that depended on the same institutions for liquidity provision and market-making activities. The Commodity Futures Trading Commission had announced enhanced monitoring protocols for Monday's market opening, while preparing emergency authorities that could temporarily suspend silver futures trading if volatility exceeded predetermined thresholds designed to prevent market manipulation or excessive speculation during periods of fundamental supply and demand imbalances that threatened orderly price discovery mechanisms. The international coordination challenges had intensified as European and Asian regulators expressed concerns about American market intervention strategies that could distort global silver pricing while creating competitive disadvantages for their domestic industrial users, who required silver for manufacturing operations that were essential to their national economic competitiveness and technological sovereignty. The Blue Sky Technical Analysis had revealed that silver was entering completely uncharted territory above $82, where traditional resistance levels and chart patterns became irrelevant because there was no historical trading data to provide guidance for potential price targets or reversal levels that could be identified through conventional technical analysis methodologies. The momentum algorithms had been programmed to continue systematic buying until they encountered significant selling interest, but the combination of industrial hoarding, dealer inventory depletion, and commercial short covering had eliminated most potential sellers while creating conditions where any available silver was immediately absorbed by desperate buyers, regardless of pricing considerations that would normally provide natural resistance during rapid price appreciation. The January 2026 effect analysis had identified approximately $52 billion in institutional capital that would be systematically deployed into precious metals during the first quarter of 2026, as pension funds, endowments, and sovereign wealth funds implemented annual portfolio rebalancing decisions that prioritize the best-performing asset classes from 2025 while reducing exposure to underperforming categories according to predetermined allocation strategies. CalPERS had scheduled the implementation of a $16.8 billion precious metals allocation increase, beginning January 2nd, representing institutional buying power that would likely focus on silver, given its superior performance characteristics during 2025 while providing portfolio diversification benefits during periods of financial market uncertainty and currency debasement that were expected to characterize the global economic environment throughout 2026. The Teacher Retirement System of Texas had announced similar allocation adjustments, designating $11.4 billion for strategic metals investments during the first quarter of 2026, representing systematic buying pressure that would compete with industrial procurement for available supplies that were already constrained by existing demand from technology manufacturers and renewable energy developers. The Norway Government Pension Fund Global had indicated their intention to increase commodity exposure by $14.2 billion during 2026, with silver receiving priority consideration due to its essential role in renewable energy infrastructure that aligned with their environmental sustainability investment criteria, while providing superior risk-adjusted returns compared to traditional commodity investments during periods of structural supply shortages. The mathematical convergence of industrial procurement requirements, institutional capital deployment, and commercial short covering obligations had created conditions where silver prices could experience sustained appreciation that continued for months rather than weeks, as normal supply and demand relationships were overwhelmed by strategic necessity that operated according to completely different economic principles than traditional commodity trading patterns. The blue sky price targets had become increasingly meaningless as silver entered a phase where pricing was determined by industrial capability and strategic necessity rather than financial market speculation that could be contained through traditional manipulation techniques that had historically provided price stability during periods of increased precious metals investment demand. The weekend countdown had created extraordinary tension as market participants recognized that Monday's opening could establish new paradigms for precious metals. markets where strategic material allocation would permanently replace traditional commodity trading as the primary mechanism for determining availability and pricing of resources that had become too critical to economic security to remain subject to purely financial speculation. The silver supercycle had officially begun with Friday's destruction of the $78 resistance level that marked the transition from a manipulated commodity market to a strategic materials allocation system where industrial necessity would determine pricing regardless of traditional financial market mechanisms that could no longer influence availability when confronted by unlimited purchasing power focused on supply security rather than profit optimization. The mathematical inevitability of continued price appreciation had become apparent to institutional participants who recognized that silver's transformation from commodity to strategic material represented the most significant investment opportunity in modern history, where early recognition of fundamental changes could generate wealth preservation and appreciation that exceeded traditional investment alternatives by unprecedented margins during the most significant commodity market transformation in human civilization. The countdown to Monday's opening represented more than a simple weekend break in trading activities. It marked the final hours before silver markets would permanently establish new operational frameworks that prioritized strategic material allocation over financial market speculation, while creating sustained appreciation trends that could continue for years as technological advancement accelerated consumption requirements beyond the capacity of traditional supply infrastructure to provide adequate availability at stable pricing.